Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, to discuss why peak and pause does not necessarily mean pivot. Steve, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much, Jill. Happy Monday.
Same to you. Only 4 more days to go. Let's talk about the relative calming of what we're seeing with the Nasdaq 100 Volatility Index, or what we call VolQ, and some of the related measures there.
Yes, I mean, what we've started to see is, I think in general, some of the volatility has crept out of the marketplace, and that's okay. I mean, most of the volatility measures that we use, remember, are looking ahead 30 days. And so it's really what volatility will be over the coming 30 days. I know a lot of us get swept up in the zero-dated options fervor, but realistically, the people who are using these options to hedge, and the underlying options to hedge in the indexes themselves, they're looking out for a few, they're looking out over the course of a month as the standard. The chart we just showed was that one of the things that I tend to look at is the spread between VXN and VolQ. VolQ, as we know, is a more pure measurement of what the 30-day implied volatilities indicate for the Nasdaq 100, because it focuses on the strikes right around the money, whereas VXN basically incorporates every strike that has a bid plus, of a penny or more. And what I look to see here is there a spread between the two? And if the spread widens, it means that people are a little more nervous about the wings, buying out of the money volatility, either to protect against the downside or to speculate on the upside. Actually, I kind of think it's a little bit of both, and we'll get into that in a minute. But what it's telling me is, I think even though the volatility measures have started to come down, VolQ among them, we're seeing a little more residual, let's call it nervousness, out on the wings there.
Right. And we know that technology, many parts of it, are helping to lead the way here, and that bodes well for the Nasdaq 100. Microsoft and Apple combined for nearly 25% of the index weight. Is that concerning to you?
Unfortunately, it is. I would be much more concerned if we weren't talking about two obviously great companies, with tremendous franchises, and quite frankly, either I or my company or both basically pay a little stipend to each of them each month. So they have a resilient earnings stream. They've got great balance sheets. But when we see that sort of top heaviness, when I can't recall a situation where two stocks alone has thoroughly dominated major indices. We're talking 25% of NDX. It's about 13% of the S&P 500. That's enormous, and that really gives you no room for error. That's the problem we get into. Is we do want to see broad leadership among markets. When it starts to narrow, that can be a very worrisome sign. Either about market psychology or just general fragility. Suppose something goes wrong with one of those two companies, you can't escape it. So I find it concerning. Again, I don't find either of them highly crazy speculative, which would be very worrisome. But it's on its face, it's not a great sign.
And finally, let's talk about peak and pause. That does not necessarily mean pivot. Let me guess, you're talking about the Fed here.
How did you get that? Yeah, I mean, this is really the key right now to markets going forward. And we had basically the Fed funds futures, which I watch pretty closely, and I think it behooves people to keep an eye, if not on them themselves, but just on what they're telling us. They were implying actually less than a 50-50 chance of a hike at the next meeting. That's since gone back to about 50-50 or just over it. But after that, we're looking at rates coming down and potentially 2 to 3 cuts by the end of the year. History doesn't really show that. What we typically see is we hit a peak rate, and then we sort of stay there for six to 12 months. The last time we had, an abrupt change in sentiment was, where the Fed basically raised it and then came down a meeting or two later, was in 1995. So realistically, very few of us have been investing in a period where that didn't happen. And even in the era of the 2000s, where rate hikes were few and far between, they tended to persist for six to 12 months. So you have to ask yourself, what is the market anticipating then? Since the Fed dot plot had rates going out to 5.10 by the end of the year and staying there, that sort of is copacetic with what history shows, keeping rates at relatively elevated rates. Do you really expect the Fed to sort of say, oh, we whipped inflation, now let's start cutting rates? That doesn't seem realistic. They'll keep them there until they need to. So then what would require them to start cutting rates, to do an about face? It could be a recession, it could be a financial crisis, it could be some exogenous event. But all the ones that come to mind, none of them are very equity market friendly. None of them are good, quite frankly. So I do think investors have to be very cognizant about what they're seeing. And if you're buying simply because you see the likelihood of lower rates in the future, ask yourself why. There may be some good reasons for it. I'm open to them. Please send them in. But as of now, I can't really come up with a positive scenario that would yield lower rates in the immediate future.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.